Hey, this is Tim, licensed loan officer. I help first-time home buyers build equity and wealth through home ownership. Thank you so much for watching. Today in this video, we're going to talk about loan to value. Thanks so much for watching. If you're new to this channel, make sure you like, share, subscribe. And today is a good, important video. We're talking about loan to value. This is a series I'm doing called Mortgage 101. And I'm going to go ahead here and share my computer screen here. And this is the Google definition. Loan to value. Now, we do call this in the mortgage world LTV. It is a measurement comparing the amount of your mortgage with the appraised value of your property. So that's basically, in a nutshell, what loan to value is. It's your mortgage compared to how much it's worth. So let me go over here and show you this real quick here. So let me go. I forgot to change this. Okay, so loan to value is more for refinance over purchase, but I'm just going to explain it with purchase first. So as a purchase, your purchase price for hypothetical is $200,000. You're going to have a 3% down payment, so that's $6,000. Now, if you divide your loan amount by the purchase price, that will be your loan value. So let's just do the math real quick here and show that to you. So 194 is your loan amount. Divide that by 200. That's 97. That's 97% right there. And that will be, so let's do one more example here. So we have a purchase price of $150,000. You're going to put a 5% down payment. So we'll do the math again here. All right, so we're going to do a loan amount, $142,500, and divide that by 150. 95%. And then you may ask yourself, Tim, why does this matter? Why does this matter? And I will answer that question. So there are different loan to values. So there's the minimum of 3% down. The 3% down is for a first-time home buyer. So if you have not bought a home or been on the title of a property in the last 3 years, you're considered a first-time home buyer, and you can put 3% down. Now, if you're buying a second home, or you have owned a home, or you sold a home and bought another home, the minimum will be 5%. And then there's 90% and 20%. So all these have different interest rates. So if you have a little bit more money put down, you can get a little bit better rate by putting 2% more down, and then 90% and then 20%. Also, anything over 80% loan to value, you have something called mortgage insurance. And mortgage insurance is based on your debt to income, your loan to value, and your credit. Now, some people have really good credit and good debt to income. So where they have a little bit of mortgage insurance, it's not very much, because mortgage insurance is money that you pay in your regular payment, and it basically insures the lender that if you were to default and not make your mortgage payment, how much money you get back. Now, I want to show you something else too real quick here. Now, this is New America Funding. I used to work at this company, and you can go to Rocket or Wells Fargo, any site you want, and they're going to have interest rates advertised. Now, if you hit the disclaimer here, see this little disclaimer? If you click on that there, a window will pop up. And let me see if I can zoom in on this so you can see. Okay, so it's saying to get this rate here, 5.7, the interest rates for 30 years, 360 months, and it's based on 3 discount points. Now, you guys may not know what discount points is, but a discount point means you can pay extra money at closing and lock in a lower rate. So this rate is not free. This rate is based on 3 discount points. And just so you know, you're not allowed to really charge 3 points. The most points you could probably charge is 2 points, maybe a little over 2. If you do 3 points, it's called a high cost loan. And it also says this is for a 720 loan amount. So the higher the loan amount is, you do get a little bit lower rate. And then it's good for a 45-day rate lock. And this is the funny thing, 60% loan to value. So you get this rate if you put 40% down and it's your primary and your credit is 740. 740 considered excellent. So what most lenders do, and all lenders do this, they advertise a low interest rate based on you paying more costs, based on you putting 40% down, having excellent credit, and they know most people don't fit into that box. But what happens, people don't read the disclaimer, they just see that rate and they click get quote, and then they call them up, and after they run their credit and see how much money they have to put down, it's a whole different story. So just so you know, read those disclaimers when you see things advertising, because it's never as good as it seems. But let's go back here and let's continue. Now this is the sweet part here. If you refinance, now most people that refinance, they care about their loan to value. And let's talk about this example here. So you have a appraised value of $250K. Your current mortgage balance is $148. How much equity do you have? How much equity? All right, I'll answer it for you. So technically, the amount of equity he has, if you take the 250 subtracted by how much he owed, 148, then he has $102,000 worth of equity. Now, you can only get that full $102,000 if you sell your home. How much equity does he have if he was to refinance? So let's do that real quick here. So let me just put this down here. And oops, it's a mess here. Oh no. Okay. Here we go. All right. So with a cash out refinance, which is nice because when you buy a home, you're sitting on cash. It's not just a home, it's a cash. So we did a cash out refinance. Uh-oh, I can't spell here. The problem, the microphone's right in front of my keyboard, so it makes it hard to type. So cash out refinance, you are allowed to borrow, messing up again, 80% loan to value. So 80%. So let's do the math. So 250 times 0.8. What is that? Let's pull up our calculator here. 250 times 0.8. 200,000. So he could go up to 200,000. So he owes 148, right? 148 minus 200, 52,000. So if he did a cash out refinance, you could get up to $52,000 with this example. But remember, with that $52,000, all your closing costs, your taxes and insurance, everything includes into that 52. So hypothetically, you probably could get about 45, 46,000 because there are some closing costs and there are some taxes and insurance. So that's loan to value. Now, if you was not taking cash out and doing a refinance, then you can go up to 97% loan to value. And that's called just a rate and term. You're just lowering your payment. But if you're taking cash out, you're allowed to go up to 80%. So that's loan to value, and that's why it matters. Hope this helps. If you have more questions about loan to value, drop me a comment. I'd love to answer it for you. Thanks so much. I'll see you again in the next video. Bye.